Good evening, everyone. Special meeting of the Town Council and Joint Finance Commission study session. Call to order. Let's take the roll, and then I'll explain a little bit about the process tonight.
Commissioner Keown? Commissioner Rogers? Commissioner Fisher?
Here.
Vice Chair Monk?
Here.
Chair Runners?
Here.
Councilmember Bristow?
Here.
Councilmember Ennie?
Here.
Councilmember Badami?
Here.
Vice Mayor Moore?
Here.
Mayor Hudes?
Here. Great. So for the meeting tonight, what we will do is we will take verbal communications next, and verbal communications would be from anyone on from the public who would like to comment on the subject matter that we're discussing tonight. And then as we engage with Mr. Schuster and go along the way, I'd like to leave plenty of room for questions and discussion. So I think probably the best thing is to kind of go through the presentation through item 1 on the presentation, and then maybe stop there and ask the council and the finance commissioners whether they have questions, and have a discussion of that first piece that was presented. And then move on to the second one, which is the 115 trust, and then have, again, the same thing, have a discussion at that point. So I don't think we want to interrupt the flow of the presentation, and that'll give us adequate opportunity. And then we could do the same thing for section 3 and 4 if there are questions on those sections as well. So with that, Mr. Constantine, you want to orient us toward this? And let me just say one other thing. I've been looking forward to this session for a long time. I think it's especially important because we have a lot of responsibility with investment of the town's assets, which are considerable. And I don't think that necessarily the Finance Commission and the Council have been on the same page. And so I would hope that we would start to get at least a common understanding of the facts and the opportunities tonight. No decisions will be made since this is a study session, but we would like to keep discussing the items to make sure that we have, as much as possible, a common understanding of the facts. So that is my intention, and I'm delighted that we're starting. So.
Thank you, Mr. Mayor, and you took the first part of my introduction, which is fantastic. I have to say that it's always a great opportunity to be sitting before the two bodies that have responsibility for the fiscal oversight of the town, especially in a session like this, which is intended to be informational and allows us the opportunity, the free-flowing exchange of questions and answers without necessarily an action that has to be taken tonight. Just an understanding of where we are and where we want to go. And a thank you to Mr. Mark Schuster and his team who have come here and are not being compensated as they are performing as our fiduciaries. They were selected after a very competitive RFP cycle to be our fiduciaries overseeing our 457 or 401A plans, where their change to our plans will garner millions of dollars in savings for our employees in terms of reduced fees and improved investments. And so I think given the Finance Commission and the Council's discussion regarding our pension and OPEB trust and a desire to be more efficient in how we deploy our capital, I think this is a great opportunity to bring an expert who advises more than 100 cities about how to do their investments more properly and who has found a way to do so more efficiently than most of our cities have in California. So with that, I'll turn it over to the mayor to introduce Mr. Schuster.
Yeah, and actually, I'd like to do verbal communications at this point. So do we have anyone here or online that would like to make a verbal comment?
There are no hands raised on Zoom.
Okay. if we have any burning questions from the public, we might have an opportunity to take those later, but obviously we have none now. So we'll close verbal communications. And so go ahead.
Wonderful. Thank you very much, and we appreciate coming up here today and having an open dialogue about, I think, not only opportunities that are out there today, but some of the problems that you've all addressed, and I think every agency in the state is addressing right now financially. Kind of taking a step back, there's no utopia. We know that. There's no perfect answer as you're debating what solution is long term. If there was, we'd all do it, right? It'd be an easy answer and we'd all push that button. In the last 6.5 years, we've gone through the most volatile interest rate and stock market movements that we've maybe ever seen. It's been dramatic. You know, 3 years ago, 2022, LAIF was paying 19 basis points. Today, it's almost, 420. We had an interest rate cut recently, but we had rates as high as 5.5%. So when it looks at the finance and the impact on any city or county or town, it's dramatic, or can be dramatic, especially when you have large assets to deploy. The way we look at it in the government sector, as we've gone up and down the state and helped different agencies look at their dollars, the first and foremost that you have to bring up, and I'll bring it here on the slide, is the fact that, get it right, Sarah, 53600.3. And that is actually a code that many people don't even know exists. It says that you're the fiduciary of every dollar that you have in this city. You're a fiduciary. So oftentimes we get into situations where people don't understand that. They'll say, well, it's easy, it's convenient. I like the person at this bank or at that location. And that's great for your personal money, your after-tax dollars. But when you're a fiduciary of any asset, you must only do what's in the best interest of that entity, regardless of the entity. So when we look at all of your assets, it's about looking at it, looking at what are the opportunities, and then after that, you making a business decision like any commission or board would do on what's the best for the town of Los Gatos. Secondly, and what we had already addressed previously, oops, I'm sorry, I went too fast. Where we first helped the town was looking at Article 16, Section 17 of the code that says, for a retirement plan, you are the fiduciary of a retirement plan, whether you want to be or not. By default, you are in the state of California. In fact, it is the verbatim law to that of an ERISA plan. You're not subject to ERISA like privately held companies are, but it is verbatim the laws around doing what is in the best interest of the plan. And so that's something that we worked on previously and have implemented, and you'll see in a few minutes the financial impact it has made. Just briefly, we're a large team of fiduciaries based out of Southern California, though we now work with, I think, over 16 agencies in Northern California. We are working on, I think, about 10 other new ones right now as we speak, as kind of the word continues to spread about there may be other opportunities out there that you previously may not have known about. And areas that basically puts monies into your pockets versus others in the marketplace, and keeping that money in your pocket, but also at the same time looking at all of the codes, the laws, the rules that government has. We were talking previously, they're unique. They're very different than the private sector. They're extremely different, okay? And so you have to look at them very carefully, very deeply about what the opportunities are, but also where you don't ever want to cross that line. We manage now, I think, over $10 billion, again, all of them as a fiduciary, focusing on agencies and special districts. These are the areas, these are the dollars. This is everything under 53600.3, whether it's a retirement plan, a pension, a retiree medical reimbursement, your pensions, your OPEBs, or really the area right now of great focus, which is your largest dollars, your operating reserves and cash accounts, and maximizing the opportunities under 53601 of the code. These are the agencies that we've done the work for, and up and down the state, from your largest to your smallest. There's really no agency we won't touch. Oftentimes, we're coming in just to help them out to, at the end of the day, put more money in their pocket from whatever vendor they're deciding to work with, just to make sure that they understand how it all works. These are the private sector, publicly held, privately held, hospitals. That's the world we came from the private sector. Still work in that sector today. We've just brought many of those disciplines and practices to the government sector that previously not many had seen before, which was keeping money in your pocket versus somebody else's pocket. So this is the impact, and what Chris had mentioned earlier is we were asked to come up. We had done this from the previous city that Chris had worked in, and for your town here. And I will share with you when we look up here on the screen. This is the financial impact, and if you look at obviously the town of Los Gatos, typically retirement plans, especially for all of the participants that you hire, if they come in at 25, they're going to realistically work for 30 years and go to 55. If they're 55, life expectancy for a 55-year-old is about age 84. It's about 29 years. They're going to have their money in a plan. So the point of this is to look at the financial impact of what fees and performance do to any portfolio. Whether that portfolio is $100,000 or the portfolio is 30 or 40 million, it has a dramatic impact. So when we came into the plan here of Los Gatos, that impact over 30 years, depending upon the natural growth, purely fee, no investment performance, was just shy of $22 million. Simply taking those dollars and efficiently putting those back into the pockets of the employees. And again, the point of that wasn't to talk about what we do. It's about the fees and the impact it can have on any type of portfolio going forward. And then down below, depending upon your investment, the investment rate of return, depending upon, again, performance, could then enhance it even further. And that's what happens when you're looking at a 2-star fund versus a 5-star fund. Knowing how financial institutions work, they by law can build any type of fee into a portfolio. They're not breaking the law. They need disclosure. And there's a big difference between disclosure and transparency. Disclosure, as you all know, could be 500 pages of data. Transparency is you can see it right in front of you and you know what you're paying. And companies make money by building in fees into their products and services. Coke wants you to buy Coke, not Pepsi. And companies, by law, they're not doing anything illegally. They're charging different fees and then moving those fees around so that they keep the money in their pocket. Our goal for anybody is to put the money into your pockets so that you can spend it on whatever you need to spend it in your town. So these are the kind of financial impacts, whether it's a portfolio of a 457 or a 115 or a bond portfolio under 53601, you want to inevitably have on your behalf. Deeper analysis going into it, this was the actual fee impact that we had completed for the city. And again, working with Gatos, she did a great job of this, helping understand it all, looking at the fees, and inevitably the dramatic impact it made for the participants, whether they were a current employee or a retiree of the town. The 115 trust is an interesting one because you have OPEB and pension liability. Our belief is when you have an OPEB plan, yes.
Mark, let's just pause there because I think the mayor wanted to be able to take questions from council after each section.
Absolutely.
Yeah, that'd be terrific. And so does anyone have a question on this so far? Yes, Mr. Monk?
Thanks. When it relates to the fees, what is different about your approach that makes you spot the disclosures versus the transparency? How do you go about
Started in New York. You'll know the firms, Alliance, DLJ, Equitable, and Pershing. Started in that world a long time ago and found where they built product and how they built their profits. Since then, I'm on the board of insurance companies, banks, custodians, and we know where the revenue is and how they make their money. So many years ago, Ashby, we started going after platforms. This goes back 30 years ago. So we know where they're putting the money, how they're making it, where they're profitable, and we're not trying to avoid somebody making money, but we're trying to limit how much they make when it comes to our clients' portfolios and plans.
It's your experience.
It's our
It's not
experience.
some piece of technology you've developed.
It is no
It's-
technology,
Yeah, gotcha.
and it's experience. And as I shared with a few of the group earlier, it took us 1.5 years to get our first city. That's how hard the vendors were fighting to keep us out.
Mr. Keown?
Could we go back to, I think, slide 15? I just want to understand the numbers.
Page 15 or
Well,
slide 15?
try page 11.
Sure.
There we go. So can you walk me through, just take the town where you have it bolded, the 33.9 million. What is that number?
That was the starting account balance that was sitting in the 457 plan before we got started. It was there with Mission Square, who is a nationally recognized record keeper, primarily focused in the government sector. So that was the account. Now, inside that account, it had funds, call it 35 to 40 funds. Inside the funds, they have built-in revenue. And I always describe this in a manner, we can buy a 16-ounce bottle of water from somebody at a stoplight for 50 cents as they open up their cooler and they want you to buy that bottle of water. You can go to 7-Eleven and buy it for $2. You can go to the Marriott and buy it for $6. You can go to the Four Seasons and buy it for $10. And then you can go to one of the beautiful new stadiums here and buy that same bottle of water for $18. Welcome to the fund world. They will build in revenue into funds and the distributors distribute them. And until you go in and know how they bury them into the fund lineup or the platform, you don't know what you're paying. So what happened is we took that platform, looked at it, and then went out and went to the record keeper, which we've done hundreds and hundreds of times, and said you can make 100% of nothing or 10% of something if you want to keep this plan. So we ended up taking that, and we've done this so often, they immediately go, okay, we'll do this. So that's on the fee side.
Okay, so let's just stay, I just want to make sure I understand. So at the top, you have 6, 7, and 8. And what do those numbers represent?
Growth of a plan. So between the deferral amount that each employee is putting in, Sarah, would you do me a favor and fix my faux pas? So when you look at the starting balance of just shy of 34 million, then going forward with new contributions, along with market growth, conservatively a 6, 7, or 8% growth of any type of plan is normal. We just finished a 7-year review of the city of Ontario, a large city in Southern California. We'd done their work for 7 years. That plan actually grew at just about 11%. So 6, 7, and 8 is conservative, and it really doesn't have dramatic stock market results. It's just really about people deferring their money and watching that plan grow. So as your plan grows, fee impact is dramatic going forward.
So when it says fee saving, I'm trying to understand the slide here. It says fee savings dollars, then under the 6% column, there's a 12.8 million. What does that number represent?
So when you looked at the fee reduction, in fact, will you go to the next slide? I think this will be helpful. I'm going to go to the next slide and come back. So if you look at the fees that you had built in, that were built into the plan, we're at 40 basis points. And if you see that current 0.4, and as a reminder, 40 basis points are 0.4%. 1% is 100 basis points. So they were being charged 40 basis points. And then going forward, the new was at 14 basis points. So you look at a modest 26 basis point difference, but when you compound that on $34 million over 30 years, the fee impact alone, not investment performance.
How does this work? You obviously you understand the leakage in this. So you show up to whoever and say, we're going to negotiate your new fee structure, and they go, okay?
They didn't say okay in the beginning, but today they say okay immediately.
So for these 457Bs, your new fee structure runs around 14 basis points. Is that kind of,
Actually, that included our flat fiduciary fee,
which is a dollar amount, right?
which is a flat dollar amount.
Right.
Your basis points ended up at, was it 5 basis points? So we took them from 40 basis points down to 5. So they actually reduced that by 35 basis points. What you saw on the previous slide, other cities that actually had much higher account balances, depending upon every city or town is different. We're looking at cities right now up here with $300 million and they're paying 100 basis points. They don't know it though. They're buried into the funds and they can't see it. No differently than a checking account of which you're getting 0. You buy a 30-day treasury, which is what banks do, and they're making 400 basis points. So they're just spreads that are built in that we try to reduce to the absolute lowest amount. And then you take that, compound that over time, and that fee savings is what you see on the screen.
Thanks.
I did have a question, and that is, the example here is the 457B plan.
Correct.
So I'm interested in how that is part of the total portfolio that the town has that could be invested.
That is
And
different.
so-
That is one of your 3 buckets of money that sit out there. That is not city money, as you know, that's participant money, but it's an example of the impact that can be made in different areas.
Right. So I don't know whether you have that at your fingertips or finance director does.
We
but I'd
do.
be interested in, if we were to apply this technique to other parts of the portfolio, how big are those other parts of the portfolio that the town has?
Ashby, did you have a question? I saw you earlier. I didn't know if there was another question. So
We'll come back.
457 for now, and we can come back to there. Any other questions regarding just the impact and what it made?
Well, one other, I think I know the answer to this, but this is just being smart about how you buy. There's nothing that magical here that would prevent a city or local jurisdiction to go and negotiate lower fees with.
No, there is nothing restrictive. The difference is what we know where every dollar is hidden and how they move the nut when they lower one fee and apply it to another.
Just overall, I mean.
there was a
'cause
lawsuit.
There's a lot of disclosures around. what
There's a
the
lot
fee
of
structure-
disclosures,
And if
but
you just read that and say, I'm not going to pay 40 basis points, I'm going to only pay 25, there's nothing preventing you from going and asking, right?
correct.
Okay.
But how they, go ahead, Ashby.
No, let me come back to my question if I could. And then I want to make sure we balance the finance commissioners and the council members' questions. So what else could this be applied to in terms of the town's portfolio? This is 30-some million, which is the employees' portion. What else could this be applied to, and how big are those pieces?
So I just give you our portfolio currently with the town, which is not the employee or former employees' money. In the OPEB trust, for the post-employment trust, we have over $30 million currently. And the pension 115 trust, we have $3 million. In addition, the town managed investment portfolio is approximately $52 million. And we put last monthly report, we have 12 million in LAIF and 6.6 million was sitting in our checking account. Obviously, we need those money for our day-to-day operation, but there are some money that can be invested differently.
So Mayor, every town and city is subject to 53601, which is the California Code guiding, and I want to be very clear, guiding cities, towns, and agencies on investments that are held in these accounts. Final approval is always up to the council or the board. So if you wanted to extend beyond 53601, you're allowed to do that. However, it must be approved by council. So on the right is 53601. Down the middle are areas that we've analyzed in your IPS where there are opportunities today to enhance your yield. When we got some balances earlier in the day, Michael, who's one of our portfolio managers, analyzed it and said, yeah, there's potentially 300,000 to 400,000 more of interest earnings based upon today's interest rate market. And that's what's critical here. We have gone from 0 interest rates to 5.5, back down to low 4s right now and high 3s. So if you're not on top of that every day, that movement alone, there are opportunities in the marketplace today with the elite bond managers in the world that take advantage of these openings that put inevitably money back in the city's pockets with higher yields, yet under the code of 53601.
Yeah, thank you. I just want to come back to my question, and the answer I got was 30 million OPEB, 3 million pension, 52 million in other investments or other balances, 12 million and 6 million for, is that a total of 103? Is that correct?
Yes. I assume that the
So they
net
add
was, yes. I have to check adding up. I've just,
Okay, thank you.
Now, for short-term money, Mayor, I want you to look on this next slide. There are basically 4 proprietary companies in the industry in the state of California with pooled accounts. And this is a slide that we created years ago because all of those manufacturers come to cities direct and say, please buy our product versus somebody else's. So as a fiduciary, we put these side by side so people understand the why. Why is this happening? Why is LAIF higher than CAMP or LAIF trails? In fact, you've all seen for years that LAIF oftentimes trailed in their interest rate compared to other money market accounts that you see. And if you look up on the slide here, you can see why. When you look at the average weighted maturity of LAIF, it is approximately 9 months. So with an inverted curve, short-term interest rates are earning higher than long-term interest rates. So if you notice with CAMP, CLASS, CalTrust, and even Schwab and BlackRock's government treasury accounts, all AAA, their maturities are about 45 days. So they are going to outperform in an inverted curve higher than somebody that is buying 9-month. Now, what's going to happen is interest rates drop. As interest rates drop, you're going to see LAIF start to come up. Just a year ago, LAIF was 100 basis points lower than those 5 other pooled accounts. So in the perfect world, what an institution, an agency wants is 2 accounts, 1 of each, so that the cash management, you're moving that money as those bonds mature and interest rates start to flip because of the longer duration. And that's the perfect world to end up with another 20, 30, 40, 50, 100, $500,000 in your account, taking advantage of not only 53601, but interest rates. So Mayor, this is an area, the difference is, unlike your 457 and unlike your 115, you are restricted to a California code of 53601 of the rules of the game. You're not buying Apple or Meta in this portfolio, okay? You're restricted to short-term interest rates, average maturities under 5 years, and so that limits the opportunity to grow. Your 115 has no restrictions, 0. You could own stock, you could own land, you could own anything in a 115. It's what you use it for is what has the restrictions. But again, this is not only the pooled world, but if you go back, these are the areas inside your current IPS where you could take advantage of some of the higher yields right now in some of those securities, which could impact by several $100,000, which helps any budget going forward.
So we've been talking about returns. Could we talk a little about risk?
Yes.
And can we talk about alpha and beta risk? in the various alternatives that we're talking about?
Right now, under the 53601 or under your 115 plan where you have an unlimited ability to take risk?
I think in the alternatives that we're looking at. So,
Okay.
Yeah.
Well, first of all, I think to put in perspective, there are many uses of a technology in our industry. We use several to measure risk, obviously alpha and beta, but there's a number of wonderful systems, one of which ranks investments from 1 to 100. So the safest investment in the world, a 1, and there's only one, is a U.S. Treasury. It's regarded to be a 1. To put it in perspective, Bitcoin is 100. Is Bitcoin bad? That's debatable. The point of it, it's 100 times riskier in that model than the safest investment in the world. Give you an example. We did this earlier for a city. Restaurants. We all love restaurants. Guess what restaurants are as an investment? A 92. Okay? They're wonderful to go to, maybe not necessarily to invest in. Okay? So it's about the measure of risk, and it's always about what you're willing to do for that risk reward. In fact, we have a handout that we can share that we go into this depth, into this background, and look at extensively. In fact, would you hand that out? Yeah. And this looks at the measure of risk and the volatility and how much you're willing to take on an upside downside. And I'll have Michael share with you a little bit about how we look at that when you look at any portfolio, whether this is your personal portfolio, whether it's a 115 or whether it's a defined benefit plan. And to put it in perspective, so you all have a gauge, today CalPERS, the defined benefit plan, is roughly 70% equities and 30% fixed income. It varies, as you can imagine, as the markets move, and it varies due to the fact that inside that portfolio, there's private equity and private debt, which is marked differently than a publicly traded that has daily valuations built into them. And so when looking at this, I'll explain to you in a second, Michael, and this is Michael Gonzalez, one of our portfolio managers. The slide you are looking at, I'd like you to go to the one that has a little green and red on it. And Michael's going to explain to you about projections and that volatility in the alpha and the beta.
Hi, nice to meet everyone today. So what you have in front of you are portfolios built out of the capital market assumptions from the larger starting point scenario from BlackRock, which is produced from their software system, Aladdin. And all capital market assumptions are assumptions about the future, but we use them to build portfolios about the kind of returns we want to hit, especially when we talk about discount rates, for example, CalPERS being 6.8%. When you think about a 6.8% hurdle rate, we want to build a portfolio that has enough equities to hit that, but without taking too much risk. We want to have the highest amount of return with the least amount of risk necessary. So looking at the long-term portfolio projections, you'll see we've built out portfolios from 2080 all the way to 80-20 here. And we also have 0-100. I'll take a step back. The first number is always equities. 100% equities versus 0% fixed income. In this case, we start with 20% equities versus 80% fixed income, moving all the way to 80% equities, 20% fixed income. Now, we can build everything in between from 0 to 100 to 100-0, but this is really to show what portfolios look like, because we've encountered cities with various amounts of discount rates. Pension stabilization plans, usually about 6.8. OPEBs can vary. We've seen them as low as 3, as high as 5 and 6, even 7 in some cases. So when we're building portfolios, we want to ensure that we're guiding the returns in the way we want to get them. So when you look here, to hit a 6.8%, you're really going to build a portfolio about a 70-30. You'll see a 70-30-0, that last number is alternatives, on a 30-year projection based on BlackRock's assumptions is projecting about 6.2%. When you start adding alternatives, such as private credit in this example, you start to see the increase in returns on a 30-year basis. Now, alternatives can have a purpose in a portfolio by diversifying risk, by adding uncorrelated returns, and also by, when you look at it, decreasing volatility. So you'll see on the risk range, the fourth column from the right, it actually decreases when you introduce alternatives. Now, there's a marginal decrease, right? When you introduce too many alternatives, that's going to increase your risk proportionally. So you want to do this prudently. To the right of that risk range, you'll see this investment range probability. And what that represents is based on about 15 to 20 years of data going back, showing what this portfolio may return over a 6-month period within 2 standard deviations, 95% probability. And what this helps us think about is, if we're trying to hit a certain rate of return, how should we have a portfolio to do so? Now, those return ranges can vary. You'll see for the 70-30, the downside could be 12.1, the upside could be 19.4. But you could also have downside of 15, upside of 25. Right, we're talking about averages statistically. So this is what guides our portfolio construction. And these assumptions are updated quarterly by BlackRock. The portfolios are managed daily by our team. And we're always taking both a forward-looking view with the long term in mind, but also trying to cut through the noise. It's been a very volatile market, so it's important to be humble with the data as it comes in.
So Mayor, when looking at your beta and your alpha, you start at an overall philosophy of what is our long-term range and rate of return we're shooting for to meet our goals in the future. That future liability, which is obviously both an OPEB and a pension, and of course your current needs right now, which are cash flow regarding your own needs in the town and your expenditures that you all have. Now,
Let me just interrupt. Could you just explain for everybody beta and alpha risk?
I will let.
So beta is essentially what the market in general will give you. Think of a passive index fund, the S&P 500. That would be pure beta exposure. Alpha would be a return above a stated beta benchmark. So if you have for example, large cap growth, you can measure that by the Russell 3000 growth index. Maybe that gives you 20% a year. If you hire a growth manager and they give you 25% return, well, they demonstrate 5% of alpha above that stated benchmark.
And how does that relate to return of your asset versus volatility?
So when you think about volatility in terms of getting outperformance, you want to keep in mind, are you taking too much risk to get that outperformance? Right? If you're doubling your risk to get a marginal increase in return, is it really worth it? So you can really measure that in a few different metrics, whether it's a Sharpe ratio, such things as a Jensen's alpha, Trainer's ratio. We look at all these different metrics to really have a holistic view of risk, because not one single metric measures risk holistically. So we want to use our judgment with those things.
Okay, thank you. Since I kind of stopped you all, are there other questions from council members or finance commissioners? Go ahead, Mr. Cohen.
So I want to make sure I'm looking at the right, is this the one that you were referring to where you have the various mixes? So if I look at this, then I'm just getting focused on the 30-year, what the heck, why not? That column that says 30-year, these are the anticipated annualized returns every year over a 30-year period based upon these various mixes, right? And to the most conservative, which means the least risky, where you have a lot more in fixed income and very little equity exposure, the theoretical portfolio would yield 4.6% day in and day out, right? Right, whatever those are. And at the other end of the spectrum, if you really leaned into this and you built a portfolio, 80% equity, 10% fixed, and 10% alternatives, I guess private equity, whatever, you ratchet this puppy up to about 7%, correct? And it also has the highest risk rating, correct? So how do I think about that in relation to, because to me, this is just one side of the balance sheet. The other side is I have this huge unfunded pension liability that day in and day out, I'm going to get charged 6.8% on an ever-increasing number. And if I look at this, I see just one scenario where I exceed 6.8%. Am I thinking about this right?
You are.
So what am I missing? Because this would tell me, if I barring anything else, I would take every dollar I had and pay down debt as fast as I possibly could, because it outperforms every single scenario on this page, and, oh, by the way, has a risk index of 0. Because I'm eliminating a liability.
When you look at that and you look at this,
Is that, I want to make sure.
you are absolutely correct.
Can I,
mean,
can I hear
it's
that
no.
again? Can I?
You are absolutely correct.
Thank
If in fact the 30 years turns out to be what you see on these projections, because the reality is, if you look at the last 30 years, you would have seen similar projections going forward, and yet the markets outperform those. What I actually just put up on the slide is the CalPERS last 10 years of performance inside the defined benefit plan, including this year's 11.6%. But then I've also shown what the index, the 70-30, actually did. Now, in fairness, I wanted to disclose this. CalPERS hasn't always been exactly 70-30. So there's variations to this. I want to be very clear. And when you look at the index, this is simply equities and bonds, not private equity, not private debt, et cetera. But if you look at this, 7 of the last 10 years, they've underperformed a 70-30 index. Okay? Now, there's a variety of reasons why, okay? But they've underperformed it. And so when you look at that, yet you still look at performance. And so if you look at long-term projections and you look at what 5 years and 10 years have done, they've actually outperformed some of these 30-year projections. And markets typically have done that here in the U.S. over the last 10, 20, and 30 years. You know, we never thought we'd recover from 08. Yeah. It happened. And so could it happen again? Absolutely. But we look at these as a guide. And when you look at paying down debt and you look at what we're giving monies to somebody to pay down that debt, you have to look at that extremely prudently. But at the same time, at times you want to control your own destiny to some degree and have some diversification and liquidity so that you do control what you're doing versus out of control when it's handed over to an institution that may not outperform its own industry.
Look, I guess you could scare yourself into, never
You could
doing
either,
that.
as I started off, there's no utopia.
My point is, I want to link 2 points here. You opened up with a thoughtful discussion around fiduciary and what that means. And I think it's important for the town council, who has that awesome responsibility to act within those bounds, that they understand that we have cash on one side and everything we're talking about in a perfect world, reinvesting that and getting the highest yield on a risk-adjusted basis, which I understand. But the other side of the ledger is we have this very large unfunded pension liability that continues to grow every year for a lot of reasons. And every year we get charged by CalPERS, it doesn't a amortization payment that every year has gone up to try to reduce this. And that ever-increasing amortization payment, just in the last 5 years, has increased over $2 million. Now it's up to about $7 million. And the projections from our actuaries show that number going up over the next 10 years, like clockwork. So what that does is that constrains the town's financial liquidity capability, so ever more and more money is being siphoned off to pay this debt. So if this cash is truly excess, really the only decision that I think the town has to make is how much of this excess should be paid to pay down this debt. Because there isn't a scenario here that I've seen. By the way, there's no fees when you pay it down too. On a fee-adjusted basis, there's no scenario here that will outperform paying down that 6.8%. Is that correct?
In these assumptions,
Well, they're the ones you gave us, so.
well, and these are just long-term hypothetical assumptions. The answer is it would be very prudent, in our opinion, to do a combination of paying down and also having liquidity.
Thank you.
I am an advocate for diversification, and putting all your eggs in one basket typically doesn't work. It can, it has, but rarely does it. And so having options and flexibility, both illiquid and liquid, are prudently what you should be doing. We do AUL studies all the time. Cities come to us and say, we've just been offered a discount of 3.63, but we're earning 4.8 on our current LAIF, hypothetically. Well, actually, when you do the analysis, and do you have that here available? When you do that analysis, you can actually see, and we've just done this in the last 3 months for 3 or 4 cities, you were better off paying down the debt at 363, even though you're earning 4, because you're paying it down each time, and we'll show that. Do we have it available?
Define AUL.
Yeah, go ahead.
Go ahead.
Mr. Monk, go ahead. Yeah, okay, thank you.
It is when CalPERS comes to you each July or so and says, if you'd like to, if you pay us a lump sum right now, we're going to discount your payment by X%. Or you can continue to pay it over the 12 months with no discount. Yeah.
And I want to go back to the starting point assumptions page. There's another set of assumptions about a productivity boom as a result of AI. And you'll see here that there are assumptions. And it's really about how you see the world shaping out in the future. Next page, there's other assumptions about the impact of tariffs. I think what's important is that we're using data to make decisions. We're thinking about these portfolios in a way that represents prudent thinking about economic realities.
Yeah,
Let me just stop a second, Mr. Keelan. I want to make sure that we kind of have opportunity to ask questions, so I'll try to recognize people when they do have a question. I think Councilmember Badami has a question now.
Yes, I did. I wanted to go back to what you were saying after Mr. Keehan had asked you a question, but what I'm hearing from you, I think it's your personal opinion that perhaps the town of Los Gatos is being too conservative and not paying down our unfunded pension liability.
I think there's an opportunity to look at your cash flow going forward, your expenses going forward, and analyzing what that debt is, what the cost of that is, and coming up with a plan to prudently set aside X dollars a year to potentially pay down and X dollars a year to continue in your liquid general account and potentially into a 115. I'm a big prudent believer of a pension stabilization because that is a liability that's never going to end, to your point. It's only going to get larger, and there are opportunities to do things in controlling your own destiny with a committee and a council like yourself that you have flexibility. You don't have that today, but there is flexibility in those markets to outperform what you've been earning on those.
Okay, so what I hear you say is your guidance is we need to come up with a plan, and that being what we have a finance commission for and a town manager to put together a plan that hopefully that the council would approve of and make that policy decision.
Yes. We have not seen all of your debt liability and that future projections to come up with a recommendation at this point, but we can.
Okay, because I think some of the frustration here is that sometimes the council doesn't take the recommendations of the Finance Commission, and I think it's been a frustrating experience. So hopefully we can work together and better understand this going forward. So thank you for being here.
Absolutely.
Okay, thank you. Mr. Monk?
Somebody else.
Hi. I want to pick up on a theme that Commissioner Cohen and a few other people talked about, this notion of excess. So you're presenting us with a series of portfolios. Great. That's one half. That's the outside world. Every dollar in the town comes with an encumbrance. It's tied to something. And so the view of Commissioner Cohen is the money that's in the 115 trust is excess. It's not clear to me that's right. What I'd love to understand, I think we had a comment from you that said we need to understand cash flow, expenses, debt, costs, and make a plan. Understand what's liquid, what can go in the 115, and what could go to CalPERS. What you just described as an asset liability plan, my parlance, where we have an understanding of the short, medium, and long-term liabilities, and we can start taking assets and properly investing them to match those liabilities.
Correct.
The 115, in my mind, is a contingent set of liabilities where
trying to make more money, but there's a chance we might need it in a catastrophe.
Right, and I do not consider 115s as excess money. It is
Okay.
the reallocation of dollars into a platform to fund for future liabilities and or current expenses by that reimbursement that you have that ability. I do not consider it to be
Okay.
excess.
So I put words in his mouth.
No,
Those
no,
were my
it's quite
words.
all right.
Okay, those were my words, not his. He can say what he believes. But what I feel is we are trying to figure out how to make the plan. I think the commissioners are probably sick of me saying the words, we need an asset liability study to figure out how do we invest in the 115? How much should we put directly in CalPERS? Can you tell us how other towns are matching all of these liabilities to the assets?
Yeah, I can share with you that there is no game plan anywhere consistent. We're in 109 agencies. There is no consistency. What we're starting to see by educating councils and staff on these dollars and the platforms and everything that are involved in them, the fees, performance, what you can do, what you can't do, is to make them think more about this. And recently, we had a city come back to us with a pretty decent, they had a deficit. They had taken a cash and bond in their general account portfolio, and their enhancement earned them $400 or $500 or $600 more a year of interest. But they took the return they had gotten in their 115 pension stabilization. And to meet the gap of that as of 6/30/2025, they took the difference in what they earned versus the 6.8, and they refunded that money back to the city, took a disbursement, the delta between the two. And they had earned about 12 to 13% in their portfolio. So they took the difference. That was one model that is, after we educated the council on this, that they implemented themselves, that's their model. We have another city that is trying to put together $100 million, and they built their 115 trusts so that management in the future could not pull out money beyond 5 or 10% until they hit 100 million, so that 100 million could generate the annual income to meet future deficits inside the portfolio, believing that they felt that they could outperform on a consistent basis what CalPERS was earning inside their portfolio and didn't want to be tied to just one investment, meaning the defined benefit plan of CalPERS. That was their philosophy, and letting that money grow.
You're okay, and you're reverting to the performance of the funds and the excess return and what we do with that. I'm asking you, is there a best practice for defining, before you set the investment philosophy, what is excess in a city?
I have not seen any best practices along those lines.
How is that possible? How are towns choosing even to invest bond portfolios or what to give to CalPERS?
It is shockingly random. It is truly random.
So I did have a question.
Some far more sophisticated than others, but some where they don't even know what an investment policy statement is.
Right. As
We have one.
You do.
We do have one, just so you know.
And this session may trigger some need for some updates to that. One thing that I wanted to understand, because we talk about liquidity and the 115 trust giving us an opportunity where if we were to pay off the CalPERS, we would be locked in and we wouldn't have that flexibility. How do things like catastrophic reserves and emergency reserve funds fit into that thinking? Because surely those are also offer flexibility to deal with unforeseen things. And is that part of the asset liability study to include a look
I think
at
that's
that?
more of a prudent study of, in fact, one of your towns in this area recently came to us and said, you know, what happens if we have a fire? What happens if our city is locked down for 3 weeks without cash flow, without the ability to get to our money, right? You know, where do we keep it? You know, what happens if that occurs? And so I think that goes into your overall cash flow planning of what you do keep in a pooled account like a LAIF, Camp, Class, or CalTrust versus which, by the way, has daily liquidity, but we've all seen daily liquidity in our lifetimes possibly freeze for 24 hours or 48 during, you know, national crises. And then, of course, versus a bond portfolio that you might have 3-day liquidity to get your money back. So I think that is just part of the overall prudent cash management portion of what you keep into those conservative reserves versus sending off to anywhere. What happens if that happened here in Los Gatos? You know, a fire, any other type of disaster with cash flow over a 2-week period before some sort of state or national rescue plan were to come about.
Okay, thank you. You have probably more information to present, but I just wanted to check in whether any finance commissioners or council members have other questions at this point. Okay, not seeing any.
You're touching on everything you should be talking about. The fact that you even have this committee here today, I'm serious. We do this every day, all day long with agencies and cities every day. The fact that you're even doing this is candidly about 10 steps ahead of most everybody else. You'd be shocked. Okay, so this is wonderful that you've been having this debate so that you understand the options, the restrictions, the problems. And I started this all, and I don't care if this were your town or your own personal finances. There's no utopia. If there was, we'd all own the Hawaiian Islands, we'd all own Fiji, and we'd all own Tahiti if we all had a magic crystal ball. We don't, and nobody does. So prudent thinking, diversification, analysis, and then execution is what's important, but also creating flexibility in the future that if something happens dramatic, and oh, by the way, just take the last 6.5 years. The last 6.5 years is dramatic. A pandemic, 2 wars, right? Presidencies, whatever you want to call it, it's been pretty volatile, okay? And you have to be prepared for that and have that flexibility. Now, through that all, financially, things are working out. You may not like the left or the right, but financially, they are working out. And so you have to just have that flexibility built into whatever you do.
A question?
Yeah, go ahead, Mr. Rogers.
Joe Rogers speaking. I'm interested in from your experience about best practice. And if you take a situation such as we encountered where we had allocated money as a town for beautification projects, we didn't use it all for that purpose, and we had some left over, a fairly significant amount, in excess of $400,000, for example. What would you see would be the how you would use those excess funds? Would you have paid down some of the pension liability, or would you have said, okay, it's open season, let me hear what's everybody want to do with it?
Mr. Rogers, it would be like if I were managing your money. What is on the plate? What do you have going forward? What are your liabilities? What's going to happen in the future? When are you going to retire? When do you think you're going to die? And do your kids need funding? The reality is it's no different than here in a town. You're going to look at what do we need with those dollars? And I'm curious, that 400 grand, was that part of the general account?
It was part of the capital program, and it's based on distributed by council priorities.
But was it a separate outside asset?
No, it was part
designated?
of our general fund money.
Okay, so when you look at it, you would look at what your needs are today versus the future. And this is sincerely no differently than today you're looking at fixing your home or saving for your kids' education in the future. It's a balancing act of socking away X amount of dollars for the future, but also making sure your plumbing works. And it's a balancing act of all of your dollars. But it does take consistent review and discussion, and to where you're not 2 years later looking back going, we did nothing, we left money in a checking account when interest rates were 0 and today they're 5%. It's about consistently monitoring what you're doing and discussing it. Yes.
So I would just make the comment that it's all about prioritizing needs. And luckily this year, we started out a new format for our strategic priorities, which has really narrowed down the top 3. So when I think it comes to council with maybe some wish lists that come our way, we have to make a really sound decision based upon the strategic priorities that our town manager has outlined for us, rather than having this great big bucket list. I think it's been really helpful, and it'll be helpful going forward.
Other questions? We are still, I think, bridging number 2 and number 3 in your
I
presentation.
think we've covered 2, 3, 9, 11. I think we've, no.
Well, I want to make sure that the finance commissioners and the councilors, council members have been able to ask the questions that they need to about this issue. Are there other questions? Go ahead, Mr. Monk. No, I'll tell you. Yep.
When you were talking about the short-term liabilities, not being able to access the bank, there's those types of crises. I think I'd love to understand. This is 2 questions. This is the first part, and then I'll go to you. Should we be trying to manage that in those big crises? We're all, as a state, facing those types of things. So pushing that onto us feels like that's a lot to manage. The second question, when I hear you talking about these short-term liquidity needs, I can't help but think you're talking about a waterfall of cash needs in the short, medium, and long term, in the same way that you have developed an AI model out of Aladdin or a tariff model out of Aladdin. I think what we need are scenario planning tools for our short, medium, and long-term cash needs. Cash just being a fill-in word for resources or whatever in the city context we say there, so that we can start to understand what's actually excess and match that to these models. Do you help towns like ours model the liability side, those waterfalls, those cash needs? Is there software we can
We
buy?
don't do that. What you're talking about is a traditional financial plan for an individual or a family for a city. And then you back into those long-term and short-term needs with what do we need to make to meet our objectives in the future. There are firms out there that specialize this in government that do a very good job. We've seen that in several cities and towns throughout the state. And we can recommend to the council and the committee who those are, but we've seen them do a very good job analytically budget that out.
Before you leave your post, we would love a list of those
Certainly.
those providers.
Certainly.
Maybe town manager, would you like to comment on the work that we're embarking on the fiscal impact and financial impact work to take a better look at our 5-year plan?
Yes, we are currently reviewing RFPs, submissions from 5 entities that have, some of those firms that I know the names you would provide are listed amongst those. And we should be coming to council at our next council meeting with a recommendation on one of those proposals. We're meeting actually this week to discuss them. And they're proposals regarding fiscal condition with a 5-year forecast, which would be validating our 5-year forecast and getting their assumptions to a 5-year forecast. A fiscal impact analysis that would take a look at all the planned development through 2040, both on the revenue and expenditure side, and then a asset liability management plan, which is a third analysis. Those bid proposals will range that gamut, and then we'll present that to council.
Just one question in terms of that process. Is there an opportunity for the Finance Commission to see those responses so that maybe they could offer advice to the council.
In what respect?
There's going to be a recommendation coming to the council. Is it possible for that information to also go to the Finance Commission?
Yes, the recommendation that staff would make can be brought to finance before the council if you so desire, but it will delay the selection by probably another council meeting.
Okay. Understand that trade-off. We should discuss that. So if the responses are clear, we don't need that. But at the very least, I think we should inform the Finance Commission of what the scope is of that analysis, because they've been very involved in some of those questions previously.
And the Finance Commission had an opportunity to review the scope of the request for proposal before it went out to the public. And so we modified, and thank you to the Commission for speaking to the very detailed scope of those RFPs. And so the question I really have is, if we're making a selection, is this, what are you looking for from the Finance Commission to advise you? This is staff's recommendation to council. And so not necessarily the Finance Commission's opportunity to change the outcome of who we're recommending to you.
Yeah, just speaking as one council member, I don't necessarily think that the response has to go to the Finance Commission, but the information that's being passed to the council, I think it would be valuable to pass that to the Finance Commission in case they wanted to have some input during the council meeting or the subsequent process. I think it would be valuable. Yes, Commissioner Reiners.
Just two thoughts along those lines. I think in a perfect world, we potentially could have added some value in terms of adequacy of response from some of our experience, if you will, but I would tend to agree that losing a month in this process is painful. So I think having an opportunity to see it in advance, and then we can choose to participate or not. I'd also, my concern as it goes to council is there's going to be a price tag attached to these things, and my good colleague here has been, I think, very articulate about the need for us to really get a asset and liability plan together. And I'm just going to foot stomp here as you are listening to this tonight, the importance of us really getting our arms around the full scope of our financial situation, I think, is critical, and I think that's a critical step. So I would encourage the council not to be frightened by that particular part of the price tag, because we're not that familiar with that work, but I think it is critical.
Okay, thank you. Mr. Keown.
I just wonder if we could, I want to try to sort of bring this back to top dead center where you started off, because I think I'm very interested in what kind of recommendations you have based upon your familiarity with us. So we started off with a discussion around the 457B, which I think has 33 million. You're currently managing that, so we can set that aside. I'm assuming everyone's happy with those results. And the net is, what I took out of that, you were able to substantially reduce the fee basis from about 40 down to something like 15, which is, on a percentage basis, is remarkable. So that leaves, I was just totaling this up, we have roughly about 70 million in cash. And it's spread between various buckets. One bucket you talked about was the LAIF funds, which is roughly 12 million. What I heard you talking about is that you have a way of being, the town has the option either to make use of that or to hire someone like yourself to be able to actively manage. I guess what you're going to be doing is actively managing it better than the LAIF people are managing it. Is that correct?
Actually, for your short-term daily liquidity assets, Sarah, I'm again going to ask for your. What we are doing is helping. Our recommendations would be to work with finance on cash management. On you'd have two funds, only because of what you saw previously on this slide here, and this is critical. Go to the side by side, Sarah. This is critical because what you see. You're going to have an interest rate. Those five to
If you don't
six.
mind, it's great to get up, no problem. Please take the mic when you go so that
will.
it's recorded. Thank you.
Thank you. Versus LAIF, that their IPS is today a far longer duration. So you'd have two accounts.
I understand this.
And we just simply look at the week-to-week interest rate, and Gatos department has the ability to push that button and move it from one to the other for whatever that short-term daily liquid cash requirement is, back to that study that you want to complete of, is it 10 million, is it 20, in that bucket?
So I understand it. So
Maximizing that.
I'm just trying to understand your pitch here.
Yeah.
And what you're basically saying is, let me manage that 12 million bucket, and we have techniques.
Let us guide you with what is being provided to you in the state to oversee that on your behalf. We're not taking the money from LAIF. You're leaving it at a LAIF or a CalTrust. But it's about moving that money on a daily or weekly basis to maximize yield.
So, but who does that? I don't think the staff would have the time on a daily.
Well, it doesn't happen daily, the reality. It would realistically happen monthly as you start to see these yield curves change, which they already have since the Fed dropped rates.
Sure, right.
But we're monitoring this with cities to Mike and his entire team go to department and say, time to push the button. And it's honestly a very easy
thing to do.
5-minute, very easily to execute.
And the opportunity there, if I heard you correctly, was maybe 300,000 to 400,000 interest gain just on more actively managing.
No, that's here.
Total?
That's partially there.
Okay.
It's about reallocation.
So I just want to go through the remaining buckets just to make sure we understand. So then we have a big bucket of basically a hodgepodge of U.S. Treasuries, government agencies, and corporate midterms. And that, I think, is roughly around 52 million, roughly. And how would you attack that? Same idea that you're more actively managing that? We have someone doing that today.
What we did years ago when we came and identified the whole government space and who the manufacturers were in the space. As we looked at this, and all of you are very familiar with the finance world, we looked at it and went, where are the 5 largest bond managers in the world that focus in this area? They're not in government. PIMCO, BlackRock, Western Asset, Fidelity, Vanguard. So I call those presidents up. Why aren't you in government? And the truth was, they're like, the system, we don't like doing this silly RFP system, and it's not fair. Well, what if I could change that and get you in here and build customized SMAs to each city instead of pooled money? Because Los Gatos is different than Downey, California. Why are you in the same asset allocation as them with no choice? So we went out to them and said, how would you like to get into government? We did the same thing with Schwab and said, how would you like to get into government, but you have to do it at 1 basis point, and they did. They just weren't playing in this space. Government was limited to the vendors they even got to work with because of so many other things that we could talk for days on.
But we have today someone who's managing this government portfolio. So I'm trying to understand, you're just going to, your pitch is.
Take it to another level.
Okay.
Government by nature is extremely conservative to the point where do nothing versus do something. And that was the whole point, whether you like to hear it or not, of 53-600. 53-600 is you must do in the best interest of your town, not what's convenient or easy or my friend at B of A, I like her and she sends us cookies. And I'm not saying that happens here because candidly, working with the two of them have been unbelievable.
So who manages that government portfolio? I've forgotten. He's come and spoken to it.
Insight Investment, and it's you must be familiar with them. They have a big portfolio.
Yeah, they have a bond portfolio, but
you do it better.
There's better ways to do it. There are better ways to do this. But the whole point of us showing you the 457 is that wasn't rocket science. That was just analyzing it, having leverage and executing it to the tune of $37 million. It wasn't rocket science, okay? But it was about intellectual capital and digging deeper than 1 inch.
Okay.
That is the difference that we brought to government, and it can be done. Whether it's us or not, it can be done.
Got it.
So these are helpful questions. In reviewing the numbers that were presented, 103 million of assets, 30 million in OPEB, 3 million in 115, 52 million in investments, and around 12 to maybe 18 million in cash. This is not a decision tonight, but is this something, Mr. Constantine, that you would consider coming back to the council and describing your recommendation for how that whole portfolio should be managed, given the information that we're getting tonight?
Yes, but I want to have some questions answered tonight and present some more information to you from my perspective, if we can.
Right. So not tonight, but sometime in the future, you'd be willing to do that.
Well, I can provide some of that information tonight, but I think I need more before I can come forth based on just the conversation the council and the commission are having.
Okay. So are there other questions before we move on to, we got through number 3, I think. And so if you had more information you wanted to present from section, well, actually, yeah, from section 4.
Well, before I do, Linda, do you have a question?
Who was that?
Oh, I thought Linda had a question earlier, so I just
okay.
wanted to.
Yeah, Vice Mayor has a question.
Thank you. Yeah, just a quick one before we move on, I guess. So you heard what the proposal is coming to council about the sort of 3-pronged approach. Mm-hmm. Do you think that satisfies, at least at a sort of introductory level, what you think would be a best next step for the town?
Yes.
Okay.
I mean, what we're doing today was meant to just show you information, data, educate you, pull back the curtain on what can be done versus what oftentimes is being done. And that's for all of you to have those discussions going forward. And are there opportunities today in government that may not have been there 5 and 10 years ago? There is. Perfect. Okay, thank you.
And I don't want to cut anyone off, so did you have other questions, Mr. Monk, before we moved on?
He's got 111 of them. I've got it right now.
I have many more, but it's just, I wanted to point a clarification. It feels to me like the sauce, so to speak, that you're offering here versus our portfolio manager is you're able to bring in these big asset managers through SMAs. We, in effect, get the same exposure, if we think of that as a risk metric, at a lower cost because of your access. You talked about calling the 5 presidents of the biggest asset managers. It's great. And so they're giving you low basis point access to products, and you're bringing that into towns where we would normally be paying premium rates to smaller shops. Am I explaining it?
You are right on.
Okay. So we're getting the scale benefits even though we're not big.
Correct. And that was part of what we negotiated on behalf of all of our clients, that regardless if you were at 20 million or 200 million, access. And I say this because, again, the point of the slide, I hope I clicked the right one. There we go. Today, each one of these cities and say, here. U.S. Bank comes to you and says, here. B of A comes to you and says, here. You don't have fiduciaries coming in and going, I don't care where your money is. Do a side-by-side analysis of best of class. And then, are there other options in the marketplace where, just like any portfolio, you're buying Coke and selling Pepsi, okay? So that access now, we brought those managers in. where before they would have had to gone out to an RFP to even be considered as a direct manufacturer versus just an asset, a fund that a fiduciary is dictating here, Leif, Camp, Class, BlackRock, PIMCO, doesn't matter. It's about meeting the IPS, answering to the IPS on how you manage a portfolio, which is how portfolios are managed, to your decision on an IPS. You could be conservative, you could be moderate, you could be more aggressive. But there's still 53601 that for a committee like this, you understand what you can. There is actually a city that owns stock. That's not part of 53601. It was gifted to them. And the council voted on, we accepted. It was a gift. It's approved. Not part of 53601, but the governing body is this council.
I realize, Councilmember Rennie, I cannot tell if you've had your hand up. The picture is very small in here. Do you have questions before we move on?
No, I'm just listening to everybody else's. They're very good questions.
Okay, thank you. Yes, manager.
Mark, the remaining part of your presentation is very specific about market, investment, rate of returns, and whatnot, correct?
Yeah, the point of the rest of this was just, this is, believe it or not, this is a slide that whether you're a town, a city, whether you have $1 million or $1 billion, it is, believe it or not, the most popular slide that anybody ever asked to look at. Kaleidoscope.
Mark, can you take the microphone, please?
I'm sorry. It's a market kaleidoscope with the 11 leading sectors in the market, ones that we're all familiar with, whether it's large cap, whether it's value, whether it's commodities. And you look at just volatility, you look at it screams for diversification is what it screams for. And it also screams for staying the course. When you look at 2022 and large cap growth is down 29%, and what most investors do is they panic, they sell, and then the next year it earns 42%. And they've lost the back on the upside. And so it's about taking all of this data we're showing today, analyzing it, but then customizing it to who the town of Los Gatos is. What you're trying to achieve with your cash flow, with your expenses, with your future liabilities, with discount rates, with your debt, and then coming together with a plan to then back into what rate of return do we need to achieve to hit that. And that then dictates your risk. Why is CalPERS at 680? Because, at a 70-30, because they have to be based upon projections to hit their 680. Why don't we typically show a 0-100? Because candidly, that's actually riskier at times than a 20-80, because you're not going to hit inflation if you're in all fixed income for a longer period of time, especially when interest rates were 0 to 2%. And so this is just more of looking at what markets actually do versus what people think they do, okay? And that emotional volatility. If you think about Moneyball, which is what we go back on, Moneyball was all about the financial world analyzing unemotionally how markets perform, and then inevitably building around that. The reality is, though, if we took the general managers of the Giants, the Dodgers, and the Angels and said, who's the best shortstop in baseball, and you all use Moneyball, they'll come up with 3 different answers because they all weight it slightly different. No differently than a committee or a council might from town to town or city to city. It's going to be based upon your overall philosophies and what you're trying to achieve. But even having this dialogue is step one. So the rest of it is just a lot of market data, Chris, as you mentioned. And so I think you've really covered a lot of the areas and what you're interested in, but we did want to share with you, and really what Chris wanted to share with you is not only the opportunities in the marketplace to enhance what you're doing today, regardless of what direction you go.
Mr. Mayor, with your permission?
Of course.
So in a nutshell, the purpose of the presentation we wanted was specifically to assist the council in considering the Finance Commission's recommendation as to whether we transfer a $3.1 million balance from a pension trust to CalPERS. And it goes to a question that was raised by one of the commissioners today. And so what I'd like to ask of you, the initial comment with regards to some of the numbers are the percentages look the same whether we retain or give the money to CalPERS. What the council needs to know as they're evaluating that recommendation, are there alternatives? And so what I'm seeing here is one option is to transfer to CalPERS. The other option is to retain it in the current accounts that we have and decide on whether you do a more aggressive strategy under the CalPERS mix. And then the third option, my understanding from our discussion is there's different architecture and model that you can retain the funds and based on what you had told me before, can garner a higher rate of return than CalPERS while retaining the flexibility of holding on to those funds. Can you lay out for the council to be able to consider that decision, whether transfer or not, what options is before them?
Certainly. So today are what you've all seen in the last really 15 to 20 years, which was the creation of the 115 Trust, which basically is an irrevocable trust to fund future liabilities, but obviously to set those dollars aside either in an OPEB or a pension stabilization to meet those. You ended up having a couple of different options of platforms to put them on. Both of them pooled options, both of them very little flexibility. CalPERS came out with a very competitive low-cost option. However, at the end of the day, it was a risk-based model with State Street. They're index funds, okay? And that portfolio has underperformed the market because there's zero customization to it. In fact, you don't even have your own IPS. It's their IPS. So when we saw this in the marketplace, we went out to open architecture and looked at what could you do that is better than one option. In fact, your pension stabilization only has two investment options. The highest model is a 50-50. A 30-70 or a 50-50. So how can you hit 6.8 at a 50-50? You're not going to get there. The OPEB only has three investment options. What investor only wants to be limited to two or three options of pooled money and no customization? So what is available today is open architecture, unlimited investment opportunity. That all depends upon the risk you want to implement with unlimited investment options, whether you want to be at PIMCO or BlackRock or Fidelity or Vanguard or Apollo. It doesn't matter. All at an extremely low cost like CalPERS. And that was introduced to the market. And so that is out there today to enhance. And those performances, since it's been around, have outperformed the two other platforms significantly over the last 5 years. Just simply because of the option of flexibility. So that is out there today. What is out there today in the bond space? The elite bond managers in the world now into the space, willing to do this at an extremely low cost. Analyzing your IPS, and most importantly, understanding the IPS, understanding what it is and what you can and cannot do in it, or if you want to, do whatever you want and approve a stock. I'm not advocating that, but understanding what it does. Regarding investment returns long term, you know, that's up to your own diversification and flexibility and liquidity going forward.
So let me reframe that. Depending on how we frame our investment policy statement, there are other options that can garner over time a higher rate of return than CalPERS.
There is no guarantee to that return, but with greater flexibility and opportunity to choose from, probability says you'll outperform it. And just simply with greater flexibility. And there's a slide that we have here that creates just options. I mean, think about this today. CalPERS can go to any money manager in the world, right? They can go to any money manager in the world to invest, and they do. Your 115 gives you two options in a State Street fund.
Right, but I think to the question that was raised by one of the commissioners, what you're saying is it's a close call and there's no guarantee between transferring to CalPERS and retaining.
There's no guarantee on either.
Right. Okay.
Okay, before we move on, Mr. Keown?
I think it's important. Let me reframe this because this point is really important. I want to make sure the town council understands this. This isn't hypothetical. You know, we today have between our miscellaneous and our pension, in our safety, a $67 million unfunded pension liability that every year we get hit with 6.8% interest charge. And I asked you earlier when you were looking at these portfolios that even over a 30-year period, the most aggressive didn't even hit that 6.8. I don't think you're saying that introducing more options might be able to move us from the current, I think our current fund on inception to date yielded 2.8%. I'm sure you could do better than that. But I hope I'm not hearing you saying that with a high degree of assurance, year in, year out, over a 30-year period, you can construct a portfolio on a proper risk-adjusted basis to hit 6.8%. Am I hearing that? Because to me, the only question is, do I retain the cash to try to, ink out a little bit better return, or do I make a permanent financing decision of paying down against this debt at 6.8%? And all I'm doing is putting more assets to work. I'm exposing myself, albeit within the CalPERS framework. I don't have a choice. I guess I can withdraw, but that's the framework I got on. I'm just exposing more asset at play. Because fundamentally, our problem today is we don't. That's why we have an unfunded pension liability.
Let me answer your first question. Do I think many very talented managers over 30 years can outperform 6.8? I do. I do. I think they are out there and they can. They've proven it over the last 30 years. Is there a guarantee? There's no guarantee.
So paying down debt and reducing at 6.8% is guaranteed.
It's
extinguished.
There's nothing in CalPERS that's guaranteed. Okay.
Okay.
I mean, you're asking me a question. Would it be prudent to analyze the opportunity to take some of your dollars to potentially pay it down? Certainly. But that's just diversification of, do I take a bird in the hand of a down payment and paying off debt versus the upside of other dollars?
No, it's not
and
that.
I think that's
this is where I disagree. It's not. It's a question of timing. At the end of the day, the town has a obligation to pay off its pension liability. That's contractual. And we have a choice. We could either accelerate that payment, in which case you reduce your interest charge, or I can enter into all sorts of various schemes, of which the 115 trust is one, paying down through the normal amortization schedule of addressing how to pay. This is a simple finance 101 question. And I want to make sure people understand this, is that given the opportunity to pay off relatively high interest costs at 6.8% versus fiddling around trying to ink out a little bit more yield, maybe you can. I just, on a risk-adjusted basis, I find it hard to believe that we would want to go to all that effort when, at the end of the day, I'm going to have to pay it off anyway. Right?
correct? I mean, agreeing you have to pay it off. I think when you look at any dollars, though, you want to have liquidity and paying it off completely. And what I'm not aware of 1 million or 3 million or 10 million or 20 million. We haven't looked at all of your data on that end, but paying off at a guaranteed 6.8 versus keeping other dollars liquid and flexible, I think there's a balancing act between the two. If you said today I could pay off my entire liability as you know it today and put every liquid dollar we have and pay it off, I wouldn't recommend that.
No, that's not what we're saying. Again, I think maybe we have more knowledge than you, but the point is we have 3 million. We have total of something like 70 million of available cash, various assets. We have 67 million of unfunded pension liability. We're talking about taking 3 million and making an additional discretionary payment to be able to reduce on a go-forward basis what our annual amortization charges have been. And this is what's important, is that this hasn't been working out for us. if I go back 5 years, our annual discretionary, our required amortization payment 5 years ago was about $4.5 million. And in that interim time, we've squirreled away $3 million in this 115 trust. And today, actually for 2027, what CalPERS has told us is that our mandatory amortization payment is going to be $2 million more. We're now up to 6.5. And every actual projection that's been given to the town says that number is going to grow another $2 million over the next 10 years. So it's crowding out. It's eating up more and more of operating cash flow that comes in, is being used to pay down this debt, which we will have to pay. It's not going to go away. We're not going to earn our way out of this. We're going to have to put more money to work in this plan. And I just, for the life of me, don't understand why we wouldn't, when I see 6.8, 2.8% yield to date, or inception to date on the CalPERS plan, that's a pretty easy decision.
And we don't have that 2.8, I don't have that data on what you...
It's what was given to us.
On the last, is that the last 5 years?
It's in the deck that was handed out.
I think the overall, the conclusion at the end of your analysis, which you're clearly going through right now, may be that decision.
Well, that's the, okay.
But speaking, you're asking me the question right now without having seen all the data, I can't answer that.
Okay.
I have to look at everything you're doing to come up with, this is the best decision for your 3.1 million. It very well could be, and it may not be. I don't know that without analyzing all of your data.
I thought, reading the documents, one of the purpose was to hear what, if I was mistaken.
We haven't studied all of your finances of what all of your expenses are and everything you're doing. And so that is something that you clearly need to do going forward, but there are opportunities out there, whether that's paying it down or earning more money or lowering fees or earning higher interest, that are there for the town to consider. And that may be clearly one of the options. I just haven't seen everything to tell you after the study that Ashby, you brought up on whether we do that. We don't do those studies. We take that analysis and then determine it.
I think, Mr. Schuster, you've answered the question that there is missing information. I think there is a plan to get some of that information through the studies that we are working on now. And I would hope that we could come back to that when we have some of that missing information. Others, any questions? Mr. Fisher, go ahead.
So I had a question before the last conversation, but it was really kind of maybe piggybacking on Commissioner Keown's comment. And as we talk about projections, we look at these 30-year returns. And while I'm confident that, markets are going to perform well over time in 30 years, this is going to kind of be a mean here that we can hit. The comment that I would make and that I would have the council consider is there's variability in these returns. How much variability are there in the 6.8 that CalPERS is charging? So I think that's the important consideration is, all these returns might be very similar, but one's going to come with, a very maybe large high and a very low low, where one is going to be very consistent. And that's what CalPERS is charging. So kind of covered that in the last conversation, but that was my comment.
Great, thank you. Other questions? Mr. Monk?
This will be my last one.
No,
I promise.
Go ahead.
So rather than talking about the next 30 years, we can talk about expected return. And so the CalPERS expected return is 6.8. In large part, that's imposed on CalPERS. They've built a portfolio to meet a policy goal that is 6.8. What I think I heard you say is you believe you can build a portfolio in a 115 that has a higher expected return than 6.8. And you also mentioned Apollo, which to me is an alternative investment manager, private credit, private equity, hedge funds. And so I'd ask, can you just take us a step beyond what you've said so far and explain to me how you can make a 115 trust have an expected return above 6.8 and include not only stocks, but alternative investments?
When I mentioned, I want to clarify, when I mentioned Apollo, it was just about the flexibility of somebody having multiple investment managers accessible to them, regardless of what direction. I'm not advocating Apollo, nor am I advocating BlackRock. It is about having at least that flexibility and opportunity to even choose from that versus two options, peanut butter or jelly, and that's it. That's your option right now in your 115.
I get that. I guess I'm trying to understand the alternative investments, allocations, the equities.
The alternative investments, I would tell you right now, until people really started to understand their 115s better, which up to this point, we've seen very few towns and cities do that. They socked these away 15 to 20 years ago as an alternative in liquidity. They were given two very benign options to choose from, and they put money in them, which was good. They did that. But today, when you go out there to invest, you want to have at least opportunity to go left, right, up, or down, depending upon where the markets move. And the markets have moved. Would I necessarily recommending doubling down on private equity in your 115? Probably not. You already have that in your CalPERS. Okay?
Sorry, I'm just trying to be clear. I'm trying to understand how mathematically you get to an expected return above 6.8 in a 115. So, that's my question. I don't need to go into the other parts. I just want to understand.
Allocation.
And which allocations can you put in there to get there?
Well, let me get to our returns. It's, I think, on another. And I'm only bringing up our returns because you asked.
Is that in the deck that was?
It's not here. Our returns are not here.
So, Mr. Mayor, while we're waiting for that, do you mind if I kind of bring
Please,
this
go ahead.
back?
Yeah.
So I wanted to address, so this conversation touched upon areas that are beyond just investments. And what do we do with the money on the 3.1 million on the back end? And so I think that's, to me, as I'm watching the conversation, what I think the confusion and the challenge surrounds around that. So give me a little time and let me go back to the beginning. The nature of government is about spending money. And so when you look at finance professionals across the industry, it's about allocating that money out for services and programs and capital and utilizing it. We are not great at taking revenue and money we're sitting on and investing in it ourselves, which is why we look to professionals to assist us. We've gotten a little bit better, but from a best practices perspective, not that great at all. Even if you look at the Government Finance Officers Association in terms of what they're promulgating, it's not there. And so when we go from the best practices to what we're talking to on the investment funds, we really have to understand the entire formula that involves the government services. We start off with all the revenue, of which property tax and sales tax are our largest, property being 3 times larger. We subtract the expenses for the programs and services, so all the trade-offs of where that money goes, police, streets, library, and whatnot. And then we end up with an annual net, which we're projecting this year going forward being negative. And when you have the net, it contributes, when it's positive, to a fund balance or a balance, which we currently have. And then we take the fund balance to the area we're discussing today, and that is how much, and this goes to the asset liability management plan, which only a few cities in California have actually done. How much do you retain for liquidity and safety? How much do you retain for planned uses? And how much do you invest to maximize a reasonable return on the investment? And so the part of the conversation that Schuster is talking specifically to is only about what are your options in terms of investing that money. One of those investments being paying down debt at CalPERS to get the long-term 6.8%. And so when I look at that entire equation, the decision of whether we transfer money to CalPERS or not, unless it was you're getting massive returns just retaining it, have to take into account the revenue minus expenses to the net and what's currently happening and what will be shown through our studies to determine where are we, and then council, what trade-off decision do you want to make? You can pay down CalPERS at $3.1 million, but that $3.1 million next year and the year after may be the difference between removing police officers from a funded status to an unfunded status. And is that something you want to do, something you want to consider Do you want time to look at an alternatives? All those decisions become harder the fewer resources that you have. So while the return may be a little bit better to pay down the deficit, the trade-off is going to be accelerating the serious decisions you have to make on program and services, and that's a trade-off council's going to have to continue to discuss. So with that, I'll give it back to Mr. Schuster.
Just if I could just ask one follow-up about that. So you would also consider the role of the reserves that we have, correct? The emergency and the catastrophic reserves as well, correct?
Yes. And in terms of those reserves, I know the question that was asked before was, what is the best practice with regards to unassigned fund balance that came from the Finance Commission? Interestingly enough, the Government Finance Officers Association has a best practice which demonstrates 2 months worth of expenses as the standard. I always challenge that. And what happened at my first meeting of the GFOA Budgeting Committee, they're moving away from the best practice that specifies a specific percentage and moving to an advisory, a lower level, that is very high level and effectively says, government, you have to consider your needs to determine what the appropriate fund balances are for you, which means it speaks more to really looking at what is our short-term, long-term outlook, how secure do we want to be, and then how much do we want to invest from there.
Thank you. Go ahead.
Mr. Monk, 244 basis points over 5 years is what we've outperformed the CalPERS 70-30. 244 basis points.
And did you do that with equities in your 115?
Yeah, a 70-30.
Okay, it is a 70-30.
That's comparing to 70-30 and a 50-50 and a 30-70.
So up until now, just there for context, if you don't mind.
Go ahead.
Mayor, we have viewed, at least I think we viewed, I have viewed it as being a bond portfolio at a certain risk, generating 4%. We had a 115 that sat between that bond portfolio and CalPERS in terms of expected return, call it. The risk budget of the 115 is lower than the CalPERS risk budget. So it became very natural for us on the Finance Commission to say, if the 115 is truly excess, which we feel it is, but it's hard to tell, it should go to CalPERS because that excess is going to go make 6.8. I guess it's news to me that you can generate that kind of return in a 115. The option that we see does not do that.
You don't have it because that was the problem. The options weren't there for you to even have the ability to earn that in the market. All what we simply did is we looked at the two platforms in the marketplace and said, this is the most archaic platform I've ever seen for 2020. And all what we did is we went out to Schwab and said, how would you like to get billions of dollars? Do it at 1 basis point.
Okay.
Okay, then build portfolios in whatever in whatever investment policy, 50-50, 30-70, 70-30. But it should be noted, your OPEB is 70-30, but your pension stabilization is 70.
Right.
Your pension stabilization, in theory, should be 70-30. You're trying to beat you're trying to beat the hurdle of 6.8.
Right. In fact,
that's what it should be. If anything, by the way, your OPEB, your discount rate on your OPEB is relatively high. Now, why do we know that? So your liability is lower. Okay, it's a teeter-totter. You know, we see OPEBs as low as 3%, which means you're funding a lot more, clearly. Okay, so your pension stabilization should be 70-30, but CalPERS doesn't offer it. They only offer a 50-50.
Because they're probably trying to incentivize us to give them
You
their
got
money.
it. You said it. That's
But now on the
100%.
public
They're
record.
trying to drive the money all into that, so they don't even offer it to you. So how did we do that? Look, we're good.
That's okay. I know you're really
But
good.
we're
the
not
part
that
about
good.
your magic, I don't need
Okay,
that. I just needed
seriously,
that fact.
it's just it's moving with the markets as the markets moved. And what the kaleidoscope shows you, that if in the last 5 years, any money manager, if you were not moving with the markets, then you missed the markets.
Okay,
That's
we're
all.
kind of getting toward the end of our time here. So are there any Other questions that folks would like to ask? Vice Mayor.
No, I'll just thank the mayor and the Finance Commission. I know this has been something that's a long time coming. I think it's important for all of us to get on the same page as much as humanly possible. So thank you for helping facilitate that. And I found this to be very valuable and informative. So thank you.
Other questions? Comments? Okay.
Actually, I do have a question.
Ms. Reinders, go ahead.
Just in terms of, Chris, going forward, how this, kind of the next steps of this will get folded in with some of the other work that we're doing with the studies. How do you see that all coming together?
Aside from kind of the process of where the recommendation goes on the terms of the study, it would be triggering the studies, either at least the two that the commission tied together, the fiscal impact analysis and the fiscal condition in 5-year, and the optional ALM if that kind of fits financially. At the same time, when we're working with the council to identify their strategic priorities for the next year while the analysis is being done, and then we're doing our own 5-year projection, really would inform what type of decision do we make on the pension funds. The preliminary data that I've seen is we were projecting an $800,000 deficit when we approved the budget with the Finance Commission's recommendation. We increased that to about 1 to 1.1 million when we needed to increase the amount of funds we were putting towards litigation for some of the building projects that we currently have. So if all that comes to fruition, the deficit next year could be potentially double that number. And so what we're looking now is a short window of very difficult trade-off decisions that council's going to need to make, and the pension stabilization fund and the OPEB trust may be an option that we want to preserve for the council to consider whether they make operational cuts today, or do you leverage those funds to delay and give yourself more time to right-size the ship. But again, that is a policy shift trade-off that only the council can make.
Great, thank you for that big picture. It's very helpful. Okay, so thank you, Mr. Schuster, and your team for enlightening us and for engaging in a little bit of back and forth as well. It's been very, very helpful, I think. And so with that, I will close this meeting. Thank you.
Wonderful. Thank you.